Hi, everybody. This is Dan Sheridan with Sheridan Risk Management, and I'm glad to be here today to talk about one of our probably favorite strategies, best performing that we've been using in 2025, and it's the double diagonal. A lot of people are used to credit spread type trades. There's some very good debit spread trades using that we'd use for range bound trading. It doesn't matter whether you do a debit or credit. Some people get a little nervous about it, but they're all positive theta trades. Let's talk a little bit about it. In this example, double diagonal is the foundation is a short strangle. Uh, in this example right here, we're starting with SPX at 64.10. And we're going ahead and selling, in this particular example, a few weeks out, selling the SEP5 6480 calls, about 70 points out of the money in this example. And then on the put side, we're going to sell the SEP5 6340 puts. That's the foundation of most double strategies. Iron Condor, double calendar, double diagonal, their foundation is this short strangle, selling an out of the money call and an out of the money put. And so that gives you probabilities, you get some positive theta, you have a lot of room here, which is nice. So that's the foundation. And then in a double diagonal, we're going to go generally at least 4 days further out on our long. And we're going to buy out of the money, a further out of the money call, 10 points further out in this example, and uh, 4 days further out duration. On the put side, we're selling the 6340 put. We're going to buy the 6330. So the nice thing about a double diagonal versus maybe a double calendar, you're buying less extrinsic value. So you're getting a um, uh, little better actual decay because you're buying less extrinsic value than if I were to buy like a double calendar. Your longs are going to be the same strike as your shorts. You're going to buy more extrinsic value. That's that part of an option that decays. What I like is, generally we put trades on delta neutral. Now, delta neutral doesn't mean that there's no risk. It just means you're starting out a delta neutral. But as we go up or down, you can get short deltas on the way up, long deltas on the way down, but you get positive theta and your long vega. You're buying more extrinsic value in your longs than you're selling in your shorts. So you have a pretty wide area here. You could see over 100 points where you're staying either way, where you're staying in the profitable area, and that's double diagonal. It's a good trade, right? And um, so I wanted to share that with you. Um, we'll be having a course coming up on double diagonals that will talk about, all the specifics that we found works pretty well, when to put it on, how many days from expiration, where to sell the short strikes, where to buy the long strikes, when to put it on, when not to put it on, what volatility scenario maybe is better than others, what do you do around news events, and the most important, risk management. If you need to adjust it, or what do you do? And so wanted to share that with you. And I've also, and with the teaching, um, I'll throw in, uh, a lot of people say, hey, can I just do it with no adjustments? You could do that too. I mean, we'll teach both different methods. And for those who would say, I'd rather just put it on, no adjustments, I'll share an automated version that will manage it for you. And I've lately been automating some trades on option omega, and I'll show you that version. But we've got a course on double diagonals, and I think you'll like it. So anyways, thanks everybody. Appreciate it. And we'll see you soon. Thanks.